Hi all, I'm Jeff Palmer, Director of Operations with CE Floyd, and welcome to today's episode of Industry Tidbits. Today we will be discussing material escalation, which is a bit of a reprisal of a segment we did about a year ago when it seemed as though material escalation was at an all-time high. Seems as though maybe we thought wrong. Kind enough to join us today is Ken Simonson. Ken is the Chief Economist for the Associated General Contractors of America, which is the leading national construction trade association in the country, has over 27,000 members in 89 chapters across the United States. As a chief economist, Ken advises the association on trends with material costs, labor availability, and market segments. Ken, welcome.
Thanks. Good to be back with you.
Welcome to Industry Tidbits, your go-to resource for today, tomorrow, and the future.
Ken, when we spoke, it was almost a year ago, and we discussed the producer price index for construction. That index showed generally across the board that products and material pricing had risen about 19% in the prior year, but that the bid prices, the prices that the subcontractors were presenting to us, the GC, and that we were then turning to the owner, had only risen about 2.3%. And at the time you had mentioned that gap should be a little alarming, and that in the near future at some point that bid pricing was going to catch up and the owners were going to be receiving larger prices. Has that come true? What have you seen?
Yeah, there's really been quite a bit of movement on both the costs and bid prices since we talked. And the first slide here shows what's been going on. You're right that there was this huge run up in the cost of inputs. That would be materials bought directly from producers as well as through service centers, wholesalers, and also other services such as trucking and design services. So that red line represents the year-over-year change in that producer price index, a mix of all of those inputs. And it was rising as steeply as almost 25% year over year by last June. Meanwhile, what I call the bid price index, the formal name is the producer price index for new non-residential building construction. Essentially, it's what contractors tell the Bureau of Labor Statistics what they would charge in terms of overhead and profit for putting up a particular non-residential building. That index, shown by the blue line here, stayed very level, rising less than 2% right until the spring of 2021. Then contractors did start pushing up their bid prices. They'd already been absorbing these materials cost prices for a long time, but they never caught up with the increase in materials costs. As you can see, there was some tapering off of that year-over-year change, but as recently as January, material costs were still 20% higher than they were a year ago. Bid prices have risen at a record rate, up 16%, but that gap still means that contractors are eating some of the costs. Furthermore, right now, with the volatility engendered by the war in Ukraine and countermeasures, we're likely to see another surge in that red line. Now, many things have contributed to that increase in the inputs PPI. And the next slide shows what's happened since the low point for materials costs, which was right at the low point at the start of the pandemic. You may recall so many activities shut down, and there was real fear that we would be into a deep, long recession. So in April of 2020, many costs had dropped. They went up right through that summer of 2021. And since then, we've seen quite a bit of variation. So let me take you through a few of these. Steel mill products, the producer price index more than doubled. But you can see just at the end of this graph that they've started coming down a little bit. Lumber and plywood prices were on a real roller coaster. They dropped in the fall of 2020. They soared to new records in the spring of 2021, came back down over the fall, and now have been rising again. And then copper and aluminum, plastic, gypsum products, many others that I couldn't even squeeze into this graph, have had double-digit increases, but not as continuous as they were in early 2021. So I think we've seen some break but nevertheless, still a lot of volatility, and that can be just as dangerous for contractors as having steady increases.
How does this compare with historical levels, and are there expectations we should see out of this?
Many of these prices are at record highs in nominal terms, that is, without adjusting for the general level of inflation. And I think the most comparable period perhaps was in the 1970s, when we had widespread inflation throughout the whole economy, wages also going up. And then we did see the inflation tamp down, but at a high cost in terms of economic output. This time, I'm hopeful, and so far I'd say most economists do not expect the economy to go back into a recession, but I think we do expect slower economic growth than we had last year. And still, as I said, a lot of volatility. So contractors are going to be facing sudden price increases. And we've certainly seen that in the last couple of weeks with oil prices and steel prices.
Well, I certainly hope you're right about not going back into a recession. Ken, one question we get asked a lot from owners is, should they be putting off their projects to wait until the material market stabilizes a bit? Any advice that you could give?
Well, if I knew when the market was going to stabilize, I'd be a lot wealthier than I am. But no, I really think that owners should definitely not put off projects. Instead, they need to be prepared to deal on a timely basis with contractors. What we learned was that contractors, this is from an AGC survey that received over 1,000 responses in November and December, 84% of our respondents said that costs were higher than anticipated last year, and 72% said projects took longer than anticipated because of all of those supply chain problems. So they're responding. 2/3 of them are now saying we're putting higher prices into bids or contracts, and nearly half are saying we've put longer completion times into bids or contracts. What owners need to do, therefore, if they are concerned, as I expect they all are, about those rising prices and delays, is work closely with the contractor. So when they get a request to buy materials sooner so they can lock in that price, or to go into a price sharing agreement so that they benefit when lumber prices tumble, as they've done a couple of times. And in exchange, they take some of the risk of a price increase, but it means smaller contingency on the part of the contractor. So there are a lot of ways of working together, but putting off a project doesn't make sense for either the owner or the contractor.
Well, that's good information and good advice. Ken, thanks for joining us again today.
Glad to be back with you.
And thanks everybody for tuning in to this episode of Industry Tidbits. Please like, share, and subscribe at www.cefloyd.com. And if you have any questions, please feel free to reach out to me. I can be reached at jpalmer@cefloyd.com. Thanks.